Welcome back to the Dividend Diplomats YouTube channel. You got your boys here, Lenny and Bert, the Dividend Diplomats. Guys, we tease this. This is a brand new video. We've never talked about this before. You know what we're doing? We're earning even more income, and we're going to tell you how in today's video.
Hit that subscribe button. Give us a nice thumbs up. As Bert said, hope you guys had a great freaking weekend, guys. We're talking to you about another form of income. We've set some targets on what we want to do with this form of income, and we're going to get right into it, right, Bert?
Yeah, that's absolutely right. So we've talked on this option. Well, you've talked on this channel before about options, right? We've talked about doing covered calls with positions we have 100 shares, and we've been experimenting that. We haven't done anything consistently. We've never put targets to it. We've also started doing some cash secured puts too in here to earn some option premium. So that's really what we're going to talk about here today. We're going to talk a little bit about them. We're going to talk about a little about the strategy. Lanny, can you give a quick rundown here on what these options are to people that are newer to the strategy?
Yeah, and guys, the kind of the lower risk ways I call from an option standpoint is, having either shares secured or cash secured. So Bert indicated cash secured put or CSPs. A good example, we'll call it Company A. They're trading at $10 a share. Maybe you have, I don't know, $800 in cash. And they're trading at $10 a share, so you can go out and buy a cash secured put for $8. What that means is you're going to commit 100 shares times the 8 or $800 if the stock price is below that at the option exercise date. So the strike would be 8, and maybe it expires in a week, maybe a month. But what happens is when you sell that cash secured put, you get a premium income. And that's the income that Bert and I are talking about. And the goal there, if you don't want to own the shares, which is actually a good way to do a limit order indirectly, but if you don't want to own the shares, is you want to have the put, further away from what they're currently trading at. But obviously, the premium you'll earn is lower the more that you get away from the current stock price. But again, it's a way to earn some extra income.
Yeah.
And then the other side is the covered call. You sell a call. You own 100 shares of that company. Let's say you did buy them at $8 a share. You sell a covered call at 12. So you would earn a premium for whoever bought that call option off of you. And then if the price at the expiration date is actually below that strike price, call it 12, and they at the end it's like $11, let's say, you actually keep the premium and you keep the shares. Now if it goes over, then you actually have to sell, and then those shares out.
Yeah, so thank you for the rundown here, Lanny. That was a great, easy, digestible background. So what we're going to do here is we're going to start executing on this. We're going to tell you how we're doing it, what platform we're using to do it. But what we're going to do is we're going to take this Monday video and kind of hold our feet to the fire here. We're going to hold ourselves accountable and make sure that we're executing on this strategy to earn extra income, because that's why we're really doing this. We want to earn that extra income on that cash that's sitting there for a cash secured put, or for those covered calls on the positions that might not pay a dividend anymore until you can at least turn a position that cut its dividend into an income producing asset by writing those covered calls. So for us, we're going to break this down here. Where are we going to do this? How are we going to go about doing this? For me, I can do it in Fidelity. Like, I have it active on my Fidelity account. That's the brokerage I use. But I also partook in a website, in an app that Lanny found, called public.com. We're going to throw the link down there below. It's got some great option premiums, got some great discounts on there, no fees and rebates to make that option very affordable to anybody, because it can get expensive if you do it on the wrong platform. It's very cheap, very easy way to do it. And if you put 1,000 in, you're going to get a $20 stock there in your rewards, and you'll get a little bit of a discount on there. So again, if you're looking to pursue this strategy and it's not in your brokerage, check out that public.com below.
Exactly, guys. So my goal is to try to generate $1,000 in option income in 2025. Not much. My quick goal, Bert, if you don't mind me diving in, is to use maybe to do covered calls on Intel, and then to do cash secured puts on other stocks that are kind of lower priced, because again, I'm just getting my consistent feet wet here, because I've done options before. I've done them 15 years ago. I've done them 10 years ago. I probably started back up 2 or 3 years ago. Bert, I know you were doing the same. And then, this year I'm like, all right, let me actually commit. And that's why I like public.com, because it's kind of separate from everything else. I'm going to use probably between $3,000 to $5,000 in capital, but on Ally, I'll still do covered call. I'll still sell covered calls on Intel. Which again, the goal is $1,000. Currently at $115.28 for the year, so almost a 12% to the goal here, guys. Currently, I have on public, I have I have 3 contracts on SoFi. One is expiring this Friday at $10 at SoFi, and that was a $17 premium earned. I have 2 contracts at $9. Expiring on May 16th, and I earned actually $70 in premium. So those were some longer ones I did. The longer you go out, the more potential volatility there is and the more premium you'll earn. So keep that in mind. The shorter term is the lower premium, especially if you pair that up with the price that's very far away from where they're currently at. So I have $87 in premium riding on SoFi that expires pretty much May 2nd, May 16th. If they expire and I don't get the shares because the price is well above where the strike price is, I'll then rerun it again on SoFi, albeit probably at a little bit higher of a price considering the price movement upward. And then I have a $4 one that I just earned from Intel that expired on May 25th at $30 strike price on a covered call. So pretty much between last Friday and mid-May, it'll be a $91 premium period for me.
That's a fantastic period. That's going to help you get to that $1,000 very easily. Yeah, for me, I'll work on getting towards 1,000. I'm going to get it, but I'm still also getting my feet wet a little bit here in this strategy. So for right now, at least throughout the rest of Q2, I'm going to make my goal more activity based than it is income based at the moment. Last week I did 2 very similar to, as I was obviously talking to Lanny about this. Intel, I had a $4 cover call for $30, expires on 5/2. So if Intel gets $30 per share, even if it hits, fantastic. I'll take that. I'll happily take that in a week. Sure. Especially considering where it's sitting at. SoFi, cash secured put, $9.50. I did it on, I think, Wednesday. Expires 5/2. So on Friday here. And that was a $10 premium. So that was $14 right there for premium for me. But I'm at least going to push myself at least once every week. I'm going to try and find some option to keep some consistent form of income going. And we'll see where the dollars go out. And for me, I might get a little tighter on the thing. I might take a little bit more risk where maybe SoFi next time, instead of 950, I'll do 10 to get even more premium. But it's going to be experimenting and getting my feet wet right now.
Yeah, right there. Burt's is a good example. I had a $10 put, cash secured put, 5/2, 17 premium. Bert did a $9.50, 5/2, $10 premium. So there's a $7 difference there in margin. And when you actually look at the annualized rates of return here, based on the capital I've committed over the time periods, when you annualize everything out on the SoFi stuff, I'm earning anywhere over 45% annualized returns right now.
Yeah, and remember, it is taxable income. It's not capital gains. So that's the one caveat we want to make sure we're putting in here is you're going to get taxed at your ordinary rate.
Yeah.
But you know what? Sorry, short term. I apologize. You're getting taxed at the ordinary rate anyway. Regardless, this is if you're paying taxes on it, you're earning the income on it. Oh well. It's good taxes to have to pay because you're earning more income and you're generating more income for yourself. Just keep that in the back of your mind though, that you will have to pay taxes on this.
Yeah, and then I'll move pretty much 30% approximately of those premiums that I earn over into, I have like a savings account that's just for taxes, so I'll move 30% out and keep the rest in the account essentially.
Yep, that's exactly what I'll be doing too. So everyone, thanks for riding with us. We're excited to start talking a little bit more about this. We'll come back next Monday and share our progress with you.
Yep. Hey, guys, like the video, subscribe to this channel. Let us know what you're doing on the option income front, guys. Let us know if you like this video and other details you might want to see, guys. And Bert, what else we got to tell these guys?
You're either with us or you're against us, Jack.
That was Bert the Herd and Lanny from the Dividend Diplomats over. Poo-hoo and out.